The large uptrend's continued strength can be seen with the gap ups that aren't immediately filled. Here is another case where a gap-related range is extended slightly lower due to the close proximity of an influential level that just happens to also be from a previous gap. In this case, it is the 55 range. A substantial downtrend still encounters temporary support from the previous 50.70 to 46.35 range. A gap down has its ranges defined by price levels close to the real bodies of the gap down and gap fill candles. The gap down also represents a short-term bearish overextension, which is why there is a passive rise, with bullish to neutral price action seen over the past 2 weeks. Now this is the opposite situation to the start of the case study, where a firmly established downtrend continues with strength as seen by gap downs that aren't immediately filled, and clear rows of persisting selling pressure with constant closes lower. When a considerable recovery is in progress, the 40 to 42 gap down range still offers firm resistance to the bullish continuation. Although 2016 started bullish, the longer-term context is still very much bearish, since a bearish reversal range forms within the gap range, but doesn't fill in the gap down. The 4270 level marks another one of those cases where there is the blurred boundary between a triple top and a compact head and shoulders, due to the second downswing peaking slightly higher. April sees a slight pause at the 40 boundary that turns out to be the right shoulder in a head and shoulders outline. The neckline range does start closer to 40, but it is also correct to extend to an inclined neckline range due to the influence of the small inclined double bottoms influence from the end of 2015. Clear resistance for the early uptrend is the wider 37 to 40 range due to the close proximity of the gap down fill, and the old 40-30 level near the start of the larger head and shoulders neckline. As usual, the approximate area of intersection from a head and shoulders downtrend line and a solid price level can point to a time period and price range where there is stronger resistance potential. This is especially helpful as the wider gap down range is developing a potential triple bottom. This triple bottom is likely to be a major reversal because it breaks a theoretically stronger area of resistance from the downtrend line intersecting with 34. In addition, there is the general observation of more green and less red on the chart as July begins. Indeed, a significant shift from bearish to bullish sentiment in the short, medium, and long term is taking place. The gap down is also being filled. The triple bottom range also has the additional bullish feature of an incline that can be used to gauge potentially stronger support as the gap down fill pushes price back to the important 34 level. Due to the great volatility starting August, the wider 34 to 31 range becomes the site of a bullish reversal that takes advantage of two trend lines from the triple bottom. This more accurately marks the wider range where support potential is increased from the intersection of uptrend lines and a support range. Later, at the start of 2017, there is a similar situation, except this time, a gap down breaches the stronger support potential from the uptrend line and the 34 level, that later offers resistance. This prevents a bullish spike from completely filling in the gap down in February. The gap down range is conveniently defined near the opening and closing prices of the large gap down candle in mid-May. Bearish sentiment bolstered the resistance offered by 2440. This can be seen by three methods: falling price action and sustained selling volume in the following weeks. The steady downtrend following the gap highlights a less common occurrence of a horizontally flipped ascending triangle outline, forming a solid upper resistance to sustain progressively lower downswings. This formation is much less common compared to the more familiar bearish continuations from horizontal ranges and descending triangles. This is simply a noteworthy case to point out. The shared quality to an ascending triangle is also seen as the 2440 level becomes an influential support into 2018. This case study has demonstrated a chart is still able to have sizable uptrends in between constant bearish patterns. During early 2021, the old 16 to 19 range quite accurately defines a reversal with large bearish stars during a drastic period of bullish volatility affecting heavily shorted stocks. More famously, stocks like GameStop, ticker symbol GME, were in the spotlight during the early 2021 period of bullish volatility. This also demonstrates how long-term ranges from chart patterns can still be quite precise during uncertain events from external influences.